Hello traders, in this video we are going to have a deeper look at the market profile. To start things off, we are quickly going to cover the basics of the market profile, but that is something we already did in the last video. If you haven't seen that one, you will find the link in the description. So what is a market profile? Market profile arranges separate trading sessions to the so-called profiles, instead of classical chart representations. Each trading session is represented by a typographical distribution. In this chart, you can see market profile of Euro-US dollar. Green letter A marks out the open of the trading day, and red letter X the close of the trading day. Once a trading day is over, the market profile can be collapsed to the single distribution curve. From the TPO profile, we calculated the point of control, which is the orange line with the highest amount of numbers, and the value area, which shows 70% of letters around POC. To fully understand the markets, we have to take a look at the type of traders who participate in financial markets and what is their motivation. Creator of market profile, Peter Steidelmeier, started dividing market participants into two major groups. Each group has different motivation and trades on a different time frame and with different sizes. Short-term time frame traders, STF. Traders who trade on low time frames, Steidelmeier categorized as small, mostly retail traders who want to trade on an intraday basis. They don't have enough time to wait for favorable prices and they are trading between each other around the fair value, which is represented with point of control and which both sides consider to be fair enough for buying and selling. They generally don't have enough capital to be able to move the market. Long-term time frame traders, LTF. LTF traders, who can also be called other time frame OTF traders, usually open their position for several days, weeks, months or years. They can afford to wait longer for the price level which they consider favorable. Usually, these traders are called smart money, banks, hedge funds, and institutions which have much higher capital compared to retail traders. Because of that, they can open big positions which can influence the price and create a long-term momentum in the market. Most of the time, they cannot even open the number of contracts at one price, so they have to build their position slowly up, and in most of the time, this takes several days and is causing the market to trend. With our current knowledge about market participants, we can now jump to the initial balance and distribution types. Initial balance is very simple. It is just first 1 hour of the trading day. If you are trading indices, setting up initial balance is very simple. European indices such as DAX or Eurostoxx have an initial balance between 8 and 9 a.m. Central Eastern Time. US indices such as S&P 500 or Nasdaq have an initial balance between 3:30 p.m. and 4:30 p.m., which is what we call a pit session. Although US indices are open for 24 hours a day, which is the same as Forex, they have a well-defined session with the highest volume. This is something we unfortunately don't have at FX. That's why we advise to play around with the initial balance. You can use either open of the new day, simply at midnight, London Open, New York Open, or the whole Asian session as your initial balance. At this chart, you can see the initial balance market out with the blue line on the left between midnight and 1 a.m. You can notice how market retested it during our period and sold off from there. To be able to trade market profiles effectively, we have to separate individual trading days into categories based on the initial balance of the session. Analysis of initial balance for each day can help the trader to make decisions during later trading hours. Because of that, we do recommend using the initial balance as either the first hour of the new day or the Asian session. Our examples are going to be represented with initial balance of the whole Asian range. normal day. Name of this day can be very misleading, since it's very rare to see this in a day-to-day trading. This day is typical by IB being wider than usual and not broken through during the whole day. Thanks to that, we can say that OTF entered the market in the first hour and they didn't participate anymore. Short-term traders and scalpers are very active, but they don't have enough force to move the market. To translate this to a more of a forex vocabulary, we would call a normal day a day where market made a high and low of the day during the Asian session and just ranged during the London and New York sessions. A normal variant of normal day. This is the most typical type of distribution. It is characterized by IB with normal size being broken only with one direction. Breaking IB only to one side means that OTF entered the market and is trying to move the price outside of IB. Characteristics of this day are that OTF controlled the market from open to close. Trending day is signalized by initial drive from the open, leaving very small pullback. This is created when the fair value of the market changes. Because of the sharp moves, market leaves areas of low volume nodes, which tends to be tested in the upcoming days. In this example, you can see an open drive at the A period. This is a situation where the market goes one direction straight after the open. That means only OTF participants are in charge. Double distribution. Double distribution is shown by a quick change of a value area during a day, and this is often happening during the high impact news. A quick move of value will cause the end of one distribution, break through the initial balance and make a new distribution at the opposite side of the profile. What we can see at the end of the day are two balanced distributions with significant low volume node areas. As in this example, where price made first distribution during the Asian session and the second one after driving higher, neutral day. Similar to normal day, we have an extended initial balance. If the price is breaking above IB high, this will quickly attract sellers who are likely to bring the price back to point of control or the IB low. Once sellers break below IB low, the price quickly reverses and the market will eventually close inside the IB range. Neutral day, extreme. On such a day, IB is broken out to both sides, but the market will close outside of IB range at the end of the day. This means that one side of OTF was more aggressive, non-trending day, represented with very tight IB. We can experience non-trending days during holidays or wait before high-impact news. Opening types. With market profile trading, we define 4 types of opening by looking at the previous day. Being able to identify the early opening type will help the trader set the bias for the day. Open drive is seen when the price will start running one way immediately after the market open. In these cases, the opening price can be the high or low of the day. This type of open is giving us a signal of a trend that is not clever to counter trade, and it is always smarter to wait for pullbacks and trade with the trend. Open drive is giving us a strong conviction that the fair value of the price is changing rapidly and we are entering into trending market. Open test drive is a more usual type of open when the market is on its way to test a significant level from the previous day. We are watching the reaction from previous day POC, value area low and value area high. Open rejection reverse. Similar to OTD, we can see an opening in one direction but sharp rejection from one point. Difference between OTD and ORR is the fact that ORR is usually aiming for some higher time frame levels with a lot of liquidity. Open auction signalizes a balance between buyers and sellers. In this situation, market participants agreed on a fair value for a whole trading day and the price is usually bouncing inside the previous day value area. Other attributes of market profile. Poor low and poor high are market profile structures which generally indicate a market that is too long or too short, and the shorter time frame players in the market have low confidence about the current market direction. Poor high/poor low indicates an unfinished auction, which in other words requires a price revisit to those zones to complete the auction. It can be identified at the high or low of the market profile zones with 2 or more TPO next to each other. Next is excess, which indicates the end of the auction and the start of another. Generally, excess is seen in extremes of profile and on the candlestick charts is signalized with long wicks. Last ones are single prints. These are similar to excesses, but they are in the middle of the market profile. They are simply a single TPOs which were created by fast movement in price. Often, these are revisited and can be used as an entry or exit point. So guys, this is it for the video and also for our series where we talked about auction market theory, volume profiles, and now market profiles. We hope that you liked those videos, and if you have any recommendations for videos you would like to see next, let us know in the comment section. And as always, trade safe.